There are over 560 million people on this planet who no longer trust their own government's money. And most of them have never heard of a Bitcoin ETF. They've never watched a CoinDesk livestream. They've never argued on crypto Twitter about whether we're in a bull market or a bear market. They're not speculating. They're surviving. And what they're doing right now, quietly, across dozens of countries that most American investors never think about, is quietly building the most powerful demand engine Bitcoin has ever seen. One that has nothing to do with Wall Street, nothing to do with Jerome Powell, and nothing to do with Donald Trump's strategic reserve announcement. And here's the thing that should make you pause. Bitcoin just crashed more than 46% from its all-time high of approximately $126,000, which it hit in October 2025. If this is the kind of analysis that helps you think about your money differently, then you need to be subscribed to the Wealth Continuum right now. This channel exists to give you the macro context that the mainstream narrative leaves out. Hit that subscribe button and the notification bell, because the follow-up to this video is going to be even more critical than what you're about to hear. Let's start with something that sounds almost too dramatic to be real, but it isn't. In Argentina, a country of 46 million people, inflation peaked at a staggering 201.4% in 2023. Let that sink in for a moment. 211% in a single year. You wake up, you go to the grocery store, and the same basket of food that cost you 100 pesos in January costs you 311 pesos by December. Your paycheck, denominated in the same currency, has been systematically hollowed out. You cannot save. You cannot plan. You cannot build. Every peso you hold is a slow-motion act of self-destruction. Now, Argentina has been here before. The country has defaulted on its sovereign debt 9 times in its history. 9. It has experienced multiple episodes of hyperinflation, going all the way back to the late 1980s when annual inflation hit 3,000%. So Argentinians are not naive. They are not waiting for their government to fix things. They learned decades ago that the government cannot be trusted with money. They adapted. And what they adapted to this time around isn't just physical US dollars stuffed under mattresses. It's stablecoins. As of 2025, Argentina has become the single largest stablecoin market in all of Latin America, surpassing even Brazil. Local crypto platforms like Ripio, Lemon Cash, and Bello have all reported surges in USDT and USDC transaction volumes of between 40 and 50% in periods following government-imposed currency controls. Citizens are using these platforms not to speculate. They are using them to hold their savings, to pay rent, to receive their salaries, to buy groceries, to send money to family members in other provinces. The stablecoin has become the functional currency of a growing segment of Argentine daily life. And even though President Javier Milei's aggressive stabilization program has brought inflation down to somewhere around 35 to 36% annually by late 2025, which is still nearly double-digit monthly devastation by any reasonable standard, the damage to peso trust is structural. Once a population learns to distrust its central bank, that distrust doesn't reverse easily. It tends to compound. But here's what most investors are missing when they look at this story through a Western lens. They see the stablecoin adoption and they say, okay, so Argentinians are buying USDT. Great. What does that have to do with Bitcoin? And that's the wrong question. The right question is this. What happens when 46 million people, who have already made the psychological leap from government money to digital money, encounter Bitcoin during a moment of renewed global confidence? What happens when the on-ramp, the stablecoin, becomes crowded enough and familiar enough that the step from USDT to BTC feels smaller than it once did? That's the transition we are in the early stages of watching, and Argentina is only one piece of this. Now let's go to Turkey. Turkey is a G20 economy. It has a modern banking system. It has a developed stock exchange, and yet since 2018, the Turkish lira has lost over 80% of its value against the US dollar. The country's average annual inflation for 2024 was 58.5%. By October 2025, the official rate had come down to 32.87%. But that's still a figure that would be considered a catastrophe in any developed economy. And here's the data point that should make every Bitcoin analyst pay close attention. Turkey currently leads the entire world in cryptocurrency ownership as a percentage of its population. 25.6% of all Turkish citizens own cryptocurrency, not 25.6% of internet users, not 25.6% of investors, 25.6% of the entire population. For context, the United States sits at around 21% of adults, and Turkey got there not through a bull market narrative, not through ETF launches, not through Michael Saylor going on CNBC. Turkey got there through economic pain. The single most traded pair on Binance Turkey is not BTC USDT. It's USDT, TRY, the Turkish lira to tether. And that pair generated more than 22 billion in volume in 2024 alone. That number isn't about speculation. That number is about people converting a currency they distrust into a currency they trust. Turkey's crypto user base is projected to reach 26 million people by 2026. 26 million people who have already developed the habit of self-custodying digital assets. 26 million people who have already built the mental model that money does not have to come from a central bank. And as Turkish inflation slowly moderates, Chainalysis has observed something fascinating in the behavioral data. When inflation eases, people don't exit crypto. They shift along the risk spectrum. They move from pure stablecoins into altcoins, and in some cases, into Bitcoin itself. Because once you've broken the psychological dependence on fiat savings, you don't go back. You upgrade. Now, I want you to hold those two images in your mind simultaneously. Argentina and Turkey. Tens of millions of people who have made the shift from government currency to digital assets out of pure economic necessity. And then ask yourself the question that Wall Street analysts are not asking. What is the global aggregate of this behavior? Because Argentina and Turkey are not alone. Nigeria, with its sudden currency devaluation in early 2025, saw a direct and sharp surge in on-chain crypto volume in the weeks that followed. Venezuela has effectively moved a significant portion of its economy onto stablecoin rails. Residents there colloquially refer to USDT as Binance dollars. Bolivia's inflation hit 22.23% in October 2025, and shops began listing prices in USDT rather than the Boliviano. Lebanon, Iran, Nigeria, every country on this list is adding more people to the global pool of citizens who understand, at a visceral and personal level, what sound money means. And collectively, adjusted stablecoin transaction volumes globally have now crossed $46 trillion annually. That rivals the volume of legacy payment giants. That is not a niche product. That is infrastructure. Stay with me, because the next part changes everything. The stablecoin is not the destination. The stablecoin is the bridge. And right now, hundreds of millions of people are standing on that bridge learning how to walk. The question of what they do when they reach the other side, and whether Bitcoin is waiting for them there, is the question that determines the next major price cycle. But before we get to that, we need to understand the macro environment that is shaping the conditions under which all of this will play out. Because the emerging market story doesn't exist in isolation, it's being accelerated and complicated by decisions made in Washington, D.C. Let's talk about the Federal Reserve. At its first meeting of 2026, the Fed left interest rates unchanged. Jerome Powell described the current rate environment as sitting within a neutral range. That phrase carries more weight than it might appear to. A neutral range means the Fed is not actively tightening. It means the growth dampening effects of the rate hike cycle that began in 2022 have largely been absorbed into the economy. It means we are in a period of policy pause. And policy pauses, historically, have been one of the most favorable macro backdrops for risk assets, and Bitcoin in particular. Look at the sequence every time the Fed has pivoted from a hiking cycle to a neutral or easing stance. Risk assets, from equities to crypto, have rallied. The lag varies, but the directional outcome has been remarkably consistent. Now, the important nuance here is that we are not in a full easing cycle yet. The Fed has not cut rates. ETF inflows into Bitcoin spot products, which had been running aggressively through most of 2025, saw net outflows of $278 million in January 2026. That's a deceleration of institutional selling pressure, but it hasn't flipped positive yet. The US dollar has remained relatively strong, and a strong dollar is typically a headwind for assets denominated in USD because it makes Bitcoin more expensive for international buyers. This is the surface layer of the macro picture. And this is what most of the mainstream financial commentary is focused on right now. They're watching the DXY, they're watching Treasury yields, they're watching whether Powell's going to cut at the next meeting. They're looking at the CPI print. And none of that is wrong to watch, but all of it is local. All of it is American. And the story we are actually in is global. Here's what they're not telling you. The dollar's global role is being eroded in slow motion, but the mechanism of that erosion is not what the gold bugs have been predicting for 20 years. It's not central banks dumping treasuries in dramatic fashion. It's not a sudden BRICS currency replacing the reserve status. The erosion is happening at the retail level, in the wallets of ordinary people in Ankara and Buenos Aires and Lagos. And the fascinating paradox is that the immediate mechanism of dollar displacement is dollar-pegged stablecoins. 99% of stablecoins in existence are pegged to the US dollar. So in the short term, the stablecoin wave is actually dollar expansionary. It is extending dollar dominance into economies where physical dollars were previously inaccessible. But here's the long game, and you need to sit with this for a moment. When you teach hundreds of millions of people to self-custody digital assets, when you train them to think in blockchain native terms about money and value, When you build the habit and the infrastructure and the wallet literacy, you have also built the on-ramp to Bitcoin. The person who learned to use USDT in Istanbul in 2022 is the person who buys Bitcoin in Istanbul in 2026. The pathway exists. The activation energy is lower than it has ever been. And this is where it gets concerning for anyone who has priced Bitcoin purely based on Western institutional demand. Because the institutional narrative is real, spot Bitcoin ETFs have attracted over $65 billion in net inflows since their US launch. BlackRock, Fidelity, ARK Invest, the names are all there, and the assets under management continue to grow. The ETF vehicle has brought Bitcoin into the portfolio conversation for pension funds, family offices, and corporate treasuries in a way that simply did not exist 3 years ago. MicroStrategy, now rebranded as Strategy, continues to hold over 400,000 Bitcoin on its balance sheet. The institutional legitimacy story is intact, but if you price Bitcoin only through the lens of ETF flows and institutional quarterly allocations, you are looking at only one side of a two-sided demand equation. The other side is the human side, the 560 million people who already own crypto globally. The next billion who are being pulled in by necessity, not by FOMO. Comment below right now. Do you think the next major Bitcoin rally comes from Wall Street or from emerging markets? I genuinely want to know where your head is at, because the answer to that question shapes your entire positioning strategy. Let's zoom in on the Remittance channel, because this is one of the most underappreciated vectors in the entire emerging market crypto story. Global remittance flows, money sent by migrant workers back to their home countries, represent one of the largest and most consistent capital flows in the world economy. The World Bank has reported that the average global cost of sending a remittance through traditional channels like Western Union is approximately 6.49%. On a family that receives $500 a month from a relative working in the United States, that's $30 to $45 every single month that goes straight to the legacy financial system. Over a year, that's nearly $390 in fees. For a family earning that kind of income, $390 is significant. It is a month's worth of groceries. It is a school tuition payment. And here's what's happening. A worker in the Philippines receiving money from the US via USDC on Solana or on the Tron network is now paying between 0.3 and 1% in total fees. Instead of losing 6.49 cents on every dollar, they're losing less than 1 cent. The economic incentive to switch is overwhelming, and it's not hypothetical. Stablecoin-based remittances are scaling at a pace that is beginning to show up in the aggregate data. B2B payments on stablecoin rails saw a 30-fold increase in just 2 years through 2025. Now, you might be asking, how does the remittance story connect to Bitcoin? And here's the mechanism. When a family in Mexico or the Philippines or Nigeria starts receiving remittances in USDT or USDC, they now have a crypto wallet. They now have a digital asset account. They now have the infrastructure. The habitual friction that prevented crypto adoption. I don't know how to set up a wallet. I don't trust exchanges. I don't understand private keys. Barrier has been removed by the remittance use case. And once you have a wallet, and once you understand that digital money is real, and once you've lived through even one episode of your local currency declining against the dollar, the leap to holding a portion of your savings in Bitcoin becomes logical. Not speculative. Logical. This is the demand pipeline that is being constructed quietly, transaction by transaction, family by family, across the developing world. You need to understand this before I show you what happens next. The regulatory environment is also shifting in ways that accelerate this trajectory. In late 2025, the United States passed what became known as the Genius Act, the Guiding and Establishing National Innovation for U.S. Stablecoins Act. This legislation mandated that stablecoin issuers be treated as regulated financial entities, requiring 100% reserves in liquid assets, primarily U.S. Treasuries. The effect of this is twofold. First, it gave institutional players the legal clarity they needed to begin integrating stablecoins into their payment infrastructure without regulatory risk. Second, and perhaps more importantly for the emerging market story, it embedded the US dollar further into the global digital payment system at precisely the moment when traditional dollar-denominated banking is becoming less accessible to parts of the developing world. American sanctions, de-risking by correspondent banks, and the general increase in KYC and AML compliance costs have been quietly cutting off access to dollar-denominated banking for smaller emerging market economies. Stablecoins, paradoxically, are providing an alternative dollar rail, one that is more permissionless, more accessible, and less bureaucratically burdensome. This is not going unnoticed by governments, and that tension between the stablecoin-driven dollar extension and the sovereignty concerns of emerging market central banks is itself a source of instability that tends to push citizens further toward Bitcoin as the genuinely neutral alternative. Let's talk about where the smart money is positioned right now and what the on-chain data is telling us about the structure of this market. Because the price story and the ownership story are very different things right now, and the divergence between them is important. As of the third week of February 2026, but here's the nuance. Small wallets, the shrimps, those holding less than 0.1 Bitcoin, have increased their total share of supply by 2.5% since the October all-time high. Meanwhile, the large holders, the whales and sharks with 10 to 10,000 Bitcoin, have reduced their positions by approximately 0.8% since October. This is a pattern that has occurred multiple times in Bitcoin's history during transitional periods. Retail buyers absorb the distribution from larger holders, building a more distributed, more resilient ownership base. It produces choppy, frustrating price action in the short term, which is exactly what we've been seeing. But it also historically precedes the next phase of accumulation by larger institutional players who re-enter after confirming a base has been established. The open interest picture tells a complementary story. After the spike in leverage that accompanied the October 2025 high, the market has gone through a significant deleveraging event. Billions of dollars in long positions were liquidated during the February 5th crash. And that liquidation, while painful, served an important function. It removed the speculative excess that had built up. It reset funding rates. It created a market structure where the next move up is not immediately burdened by the weight of crowded leverage. The pain of February, in other words, may be the price the market had to pay to set up the next move. That does not mean the bottom is in, and I want to be clear about that, but it does mean the technical setup is healthier now than it was at $90,000 with everyone crowded into longs. Hit like if you believe we are in the early stages of a multi-year demand wave from emerging markets that most Western investors don't see yet. And if you know someone who has been doom scrolling about Bitcoin crashing and they need to hear this perspective, share this video with them. Seriously, this might be the most important context they consume this month. Now let's get into the scenarios, because this is where I want you to actually think, not just absorb. I'm going to walk you through 3 realistic paths for the market from here, and I want you to consider which one your current positioning is betting on. Scenario 1, the slow burn. In this path, the Federal Reserve keeps policy mostly unchanged through 2026. No aggressive rate cuts, no dramatic pivot. The dollar stays strong. During this period, something important happens quietly. On-chain accumulation continues. Stablecoin usage expands across emerging markets. Millions of new users become comfortable holding digital dollars, even if they're not yet allocating heavily into Bitcoin. ETF inflows stay neutral, not explosive. Then, toward late 2026 or early 2027, as macro conditions soften and policy turns more accommodative, Bitcoin breaks out. This time driven not only by institutions, but by mass global retail adoption building underneath the surface. In this scenario, patience wins. Scenario 2, the liquidity shock. In this path, something breaks in the global financial system. It could be commercial real estate stress, it could be sovereign debt pressure, it could be a banking event in Europe or Japan. When liquidity shocks hit, markets usually go risk off first, and that includes Bitcoin. A sharp drop toward $50,000 is possible, but history shows that the second phase is what matters. When central banks respond with liquidity and rate cuts, hard assets tend to surge. For investors with dry powder, a liquidity shock is not destruction. It's a reset opportunity. Scenario 3, the extended correction. This is the scenario most people don't want to consider. Historically, after major cycle peaks, Bitcoin has sometimes entered 12 and 14-month corrections. If the October 2025 peak marked a macro top, the market could spend much of 2026 rebuilding structure. Some technical models suggest potential support zones between $25,000 and $30,000 before a true long-term bottom forms. This scenario would test conviction across the entire market. But historically, maximum fear in Bitcoin has also produced maximum opportunity for long-term investors. The key question is psychological, not analytical. Can you hold through volatility if it actually happens? Here's the part most analysts are missing. In every scenario, emerging market demand keeps growing, because adoption in places like Argentina, Turkey, and Nigeria is not driven by price speculation. It's driven by currency instability, inflation capital, controls, limited banking access. When local currencies weaken against the dollar, crypto usage often increases, not decreases. A strong dollar environment may slow institutional flows, but it simultaneously accelerates real-world adoption across the developing world. That structural demand layer is growing regardless of short-term price action. The bigger picture, most investors are missing. The conventional narrative today is that crypto is in a bear market, that institutional momentum has slowed, that the ETF trade is over, but that narrative is focused almost entirely on the United States. The US has roughly 330 million people. Emerging markets represent nearly 4 billion, and millions of those users are being onboarded not by hype, but by necessity. In Ankara, people hedge against currency volatility. In Buenos Aires, freelancers receive payments in digital dollars. In Lagos, cross-border transfers are happening faster and cheaper than traditional rails. This is not just an asset trend anymore. It's a monetary network adoption curve. Historically, monetary networks don't mature in one cycle. They grow in waves. First wave, early adopters. Second wave, tech investors. Third wave, institutions. Fourth wave, global necessity. Driven users. And that fourth wave may be the largest of all. No one can predict the exact path or timing, but the direction of adoption in a world facing persistent inflation and currency instability is becoming clearer every month. Short-term price charts show noise. Global adoption shows signal. If this perspective helped you zoom out from the daily volatility, subscribe to the Wealth Continuum. And share this video with someone who is watching the chart right now and feeling uncertain, because understanding the long-term signal changes how you see the short-term fear.